Hello, I'm thrilled to welcome Sherwood Neiss, principal at Crowdfund Capital Advisors. Sherwood helped to craft the legislation that helped to create regulation crowdfunding, and he advises governments and businesses all around the world about investment crowdfunding. Sherwood is also the co-author of Crowd Investing for Dummies, published by Wiley. Sherwood, I'm thrilled to have you here. Thank you for joining me.
It's great to be here. Thanks for having me.
So at Crowdfund Capital Advisors, I know that you spend a lot of time looking at data about what's happening in the investment crowdfunding ecosystem. So 4 years in now, what does that data tell you about regulation crowdfunding's role in this ecosystem?
Well, I think we are at a tipping point. Recently, I was referring to this next coming fiscal year, and I say fiscal year because regulation crowdfunding kicked off on May 16, 2016. So it just ended its fourth fiscal year. But I think this coming fiscal year, we're at a tipping point for several reasons. One, there seems to be just more traction happening in the space because I think awareness is finally catching up that people can use this as a means for raising capital. Two, I think that we're at a tipping point because we've got this proposed amendments in front of us that will raise the caps that issuers can raise 1 million to 5 million. So a lot more companies that were like, listen, I need more than $1 million will now be able to use this. And three, since we're facing this economic crisis in front of us with coronavirus, with Black Lives Matter, and we have to be able to get capital going to businesses that can't either get it because they're minorities and banks aren't lending to them, or because the crunch that's happening in the marketplace, the VCs aren't lending. More people are going to be coming to regulation crowdfunding. So the data shows, if you look at it, that we're up year over year in terms of the number of offerings. May itself turned out to be the second largest month for regulation crowdfunding. It was over $15 million in invested capital. The only other month to exceed that was October of last year, and that was 18 million. And we're only 10 days into June right now, and we're on track to do well over 15 million this month. So it's looking good.
Wow, those are some big numbers. Now you mentioned the offering cap. Currently it's $1 million, and under the proposed changes we'll go to 5 million. And I was interested to discover in kind of researching before we talked that you originally kind of wanted it to be a $5 million cap, but then kind of dialed that back intentionally. Is that right?
Yeah, so the way in which regulation crowdfunding came to be was three entrepreneurs that started their own businesses, that raised money from VCs, that understood how the VC world worked and who they funded and when you start stepping on toes. And so when we came up with the framework for this, it was originally 5 million, as you mentioned. And so we talked to our friends in Silicon Valley and we said, if we start pushing this idea through Washington, D.C., and talking to people in Congress, will you get behind it? And they were like, at 5 million, that's where we write checks. But if you dial it back to 1 million, you're not going to be stepping on any of our toes. So that's where we came up with the $1 million cap.
Got it. So you talked about the changes that are being proposed, and in addition to raising the cap, I understand there's at least some discussion right now about changing the definition of an accredited investor. Is there anything? What changes if any, would you like to see in that definition going forward?
The accredited investor definition worked for a very long period of time because the people that were accredited mainly were the people that had the knowledge about investing in private capital markets and also had the capital. Fast forward to today, we've got information at our fingertips. We all live online. Clearly, we're doing this interactively via Zoom right now. So you can get information from an entrepreneur or an investor live direct. You don't have to rely on buckets or classifications to protect investors anymore. You've got finance professors that are not accredited investors, but clearly understand how startups function, run, what makes a smart startup, and can probably make an investment decision without the guidance or the oversight of the government telling them how much they can risk or invest. So I think to take into account that people work in certain careers where they understand the risks associated with investing in private offerings, they have some sort of understanding themselves through education. Maybe it's an MBA, but they're not accredited rich would be another reason. I mean, there's just other scenarios whereby someone's smart enough to make an investment decision without the government saying, no, you can't.
Yeah, it's funny. I was having a conversation recently with Anthony Zhang. He's an entrepreneur, and his latest company is a company called VinoVest, which is for investing in wine. And we were talking about the same issue, and he pointed out that the analysts working at venture funds in Silicon Valley typically don't make enough money to qualify as accredited investors, and that's what they do all day is evaluate startups for investment, and yet people can't invest on
Right,
their own money.
right.
There certainly makes a lot of sense to see some of these changes, especially raising the cap and making some of those adjustments. But there's some, I was reading a column from Morningstar recently where, they were making the case that it's almost too dangerous to allow people, unaccredited investors, to increase the amount they can invest. I'd be curious to know what your perspective is on how they see these changes.
Morningstar has a vested interest in making sure that people use public equities in order to make their investment decisions. They write reports, they have analysts that cover public stocks. There's zero incentive from Morningstar to want the private capital markets to grow because it doesn't make any money for them. So I think they're biased, A, in what they were saying because there's no money in it for them. B, clearly Morningstar has not even bothered to read the legislation or the rules. Because if what they're talking about is it's too risky for investors, is $10 too risky for an investor to put into a business? Because I'm pretty sure the framework for regulation crowdfunding allows you to invest $1. I mean, you can invest as little as you want. So for them to say that it's too risky and just overall blanket statement, no one should be able to do this, shows disrespect for their ability to actually understand what this framework is, how it's structured to protect investors by providing adequate disclosures so you can read as much as you want about these companies, but also guardrails on how much they can invest. In the framework, in the rules, in the legislation, investors can only invest up to 10% of their income or net worth if it's over $107,000. If it's under that, they can invest up to 5% of their income or net worth. And in the proposed change, it'll be the greater of, but you're talking about anyone can invest up to $2,200. If you've got savings, hopefully it's going to be more than that. But, we're not talking about risking everybody's entire savings. And I think Morningstar just was writing it from a very biased perspective.
Yeah. It's interesting to see the folks with vested interests in how things currently work. Always have things to say about the way. I hear the same thing from existing angel investors and venture capitalists who I think kind of look down on this as something less than what they're doing. And I think, as the data demonstrates, this is really opening up access to capital to people who aren't getting checks on Sand Hill Road, and really need to find new ways to fund their businesses. So
Yeah, I mean, just to jump in on
yeah,
that
sure.
point though, and let's just play around with this for a second. Angels and VCs, rightfully so, can, they've got all their own capital and they've got other people's money that they're investing as well. And they need to be smart about how they deploy that capital. But the reality is they don't invest in the majority of the deals that come across their desk because it doesn't hit a sweet spot of them. They invest in a certain sector, they invest in a certain, demographics, which is usually right around where they live, but they're not looking at deals in these communities that are spread all across the United States.
Yeah.
I think it's blatantly wrong for them to say just because it doesn't fit their investment profile, it's not open to everyone else. And the reality is the way regulation crowdfunding works, it's an egalitarian access to capital. So it means that people that live in Denver, Colorado, which might not be a hub for VC capital, but clearly we've got great universities with brilliant people coming out of them with great ideas. If you've got a startup that's here in Denver and they can get people to galvanize around their idea and help fund it, why should we say, no, you can't do that? So they're entitled to their own opinion, but don't, just because that's how you want to do it, doesn't mean that you should preclude other people from backing people that they know, they trust, they love, they believe in.
Yeah, absolutely. And but kind of building on that, you've said kind of anecdotally that women and minorities in particular have benefited from regulation crowdfunding in a disproportionate way. And obviously, that's a timely topic given everything that's sort of in the news right now. Do you have any more specific examples of that, or places people can go to understand better how that's how this is different from the stats you see coming out of traditional kind of venture capital funding sources?
Yes. So I'm working on a piece right now that talks about Black founders and the challenges that they face in terms of access to capital. One of the things that we found is about 1% of the money in Silicon Valley goes to Black founders. Okay. The 13% of the population in our country is African American. So that's a disproportionate amount of money that's going into these type of founders. When you look at the regulation crowdfunding campaigns and the portals that are hosting these campaigns, what we find is some of them have between 11 and 12% of their campaigns being African American Black founders. So it shows that regulation crowdfunding provides an opportunity for these founders to actually go to these platforms and raise money where they're not going to get it elsewhere. And keep in mind that the way Silicon Valley and the way our bank system works, it's all relationship based. Okay, so if you're a white male, you have a lot easier access getting into the doors in Silicon Valley than if you're a Black male or a Black female. Black women have a much harder time at this than anyone else, I think. And even having relationships with these banks is very hard for African Americans as well. So if we can help solve these problems with regulation crowdfunding, we're democratizing access to capital, we're including communities that want to back these local Black founded businesses, and there's nothing wrong with it because it helps the money cycle within these communities as well.
Yeah, I think you're absolutely right. And it's interesting to see. These are situations where it's not like people are going to want to invest in these businesses because they want to make $1 billion. They want to invest in these businesses to support businesses in their communities and founders that they know. So it's a different mindset, and one that's frankly I think quite welcome. You mentioned these portals, so you know better than I exactly how many are currently active now, but there's a lot of differences in approach for these portals. So some of them, let's say, a WeFunder or a Start Engine, take a pretty hands-off approach in evaluating the companies that are raising. There's some minimum requirements to meet, but in general, if you meet those requirements, you can get listed on there for funding. And on the other end of the spectrum, you've got maybe a seed invest or a micro ventures that seem to take more of a curatorial approach to this, where they're really, some of them even advertise, well, only 1% or 3% of startups
Right.
get through our kind of gatekeeping there. I'd love your perspective on the sort of pros and cons for each of those approaches, and how that fits with sort of the way you envisioned this ecosystem working as you were sort of developing the legislation early on.
I think there's a certain amount of vetting that needs to be done on any campaign before it goes up. Primarily, we want to make sure that there's no bad actors getting into the
Sure.
system. One of the ways in which there's been zero fraud, according to a report that's been put out by the SEC in this space, is because you've got disclosures that you have to jump through hurdles to put together to publish. But we've got these bad actor checks that keep the people that have bad reputations or have done things wrong in the past out of the system. So I think it's important that we continue to have that type of minimum threshold in order to get in. After that, it really does depend on what the platform is trying to achieve. Some of them have very sector specific goals. Others have built an investment base and they know what their investors are looking for. So I think it's fine for them to say, this doesn't really meet the investment profile that our investors are seeking on our platform. Others, like Start Engine, could be a great opportunity for you to go out there. Sorry about this cough.
Okay.
And say, you've met the minimum threshold. The platforms themselves, keep in mind, are a technology platform. It's not meant for you to put up the campaign and then all this money comes flowing in. It just acts as an intermediary. You put up your campaign, but you also do the marketing. It's up to you to go out and get your investors and bring them in. The platform might do some of that just by default by having a campaign up there. But the reality is, if you're not a strong CEO with a great social base that can help support your business, you're probably not going to raise the money. The last thing that I'd say about this is the platforms differ on even the type of securities that they're trying to offer or the industries. And Next Seed is a perfect example.
Hmm.
They focus on the restaurant business, not solely, but primarily. And revenue share notes is the type of security that they promote more than any of the other ones. So if you're in the restaurant business, and I talk to entrepreneurs that have food trucks or they've got restaurants and they're struggling at this COVID period right now, it's just like, go to Next Seed. They have an excellent reputation. They've got, I think, pretty much 100% success rate in their deals. And they know how to put these deals together for you. So you can work alongside them if you've never done it before. They'll help guide you. And the revenue share notes work really well for that type of business. If you're bricks and mortar, don't try and fool people that you're going to have some VC or some private equity group buy your, business. It doesn't happen that way. Investors are smart enough to know that. You have to structure your security in the same way that your investors expect to be paid out. And so a Main Street business is going to be very debt focused in terms of the type of security. If you got a tech startup that's could have an exit or be going to follow on round from VCs, that's where you get your equity types of instruments, your safes, and all that.
Right. I'm glad you mentioned the sort of COVID-19, the pandemic situation that we're all sort of living through right now, and that's accelerated a lot of things in the economy. The trends that had been happening for a while really, accelerating them, especially things like remote work, and video technology like this that we're dealing with right now. Are there things that what kind of impact do you see the COVID-19 pandemic having on the crowdfunding ecosystem, either short or long term? I know you talk to a lot of governments, you talk to a lot of entrepreneurs, you talk to a lot of folks in this space. Are there trends that you're seeing that this are playing out as a result of COVID-19?
So when the COVID first kicked in, I was watching the markets collapse. I was thinking, oh boy, everyone's going to just stop investing. And because we collect the data every day from all the platforms and we see what's happening live, the first couple of days I was just like, it's not that much impact. Next few days, oh, it's going up. And then it continued to go up. And then, so I wrote a report that talked about the first 6 weeks of the pandemic and how there's zero correlation with crowdfunding, other than it's probably the reverse of what's happening in the public markets. And what I was thinking is, it could be that people are pulling their money out of the public markets because there's too much volatility, but they want to support these local businesses in their local communities. And so more capital is flowing into that. Or it could be that people are realizing that their options for finding financing in the traditional markets is not there anymore. So they're going to these regulation crowdfunding platforms and listing their offerings there so they could raise money. Either way, what we've seen with COVID is a huge uptick in the number of offerings and investor interest since it started.
Wow, yeah, that fits with my own experience. I on Yield Talk, we have information for investors looking at different alternative investment platforms, and I started to see a dip in traffic, in the first couple days and weeks of the pandemic. But since then, it's been it's really been accelerating, and it's almost like there's more interest than ever in things that don't look like what we're seeing, on Wall Street right now, which is a strange thing. Absolutely. So, I know you talked about getting the data every day. You're pulling the stuff in from all the different platforms. And I know there's been a lot of tracking of campaigns, whether they succeed or not in achieving their funding goals. I'm curious, is there any way or anyone tracking, especially now that we're sort of 4+ years into this, actual kind of business outcomes about, did the company succeed? Did the security get paid back? What was the return? Is there any of that information starting to trickle in?
The data that we have, companies that raise money via regulation crowdfunding have to file an annual report with the SEC and make it available on the platform to the investors. What we've seen from that data is there's a 23% growth in revenues from the year that they raised money to the year after. We've also seen in companies that have done follow-on rounds of financing that the returns, it's a book return in the sense that there hasn't been an exit, but their valuations have gone up about 60% between the first round of financing and the second. So there's paper returns that are looking pretty promising for these companies that are raising money online, but I haven't done any research, and I don't know anything of companies that have failed or closed to date.
Okay, thank you. So, with some notable exceptions, there's one platform, a Small Change comes to mind. There's really not been much use that I've seen of regulation crowdfunding for real estate investments. Yet real estate is a huge portion of the kind of Regulation D ecosystem. Um,
Right?
is it? Why do you think that is? And do you think the proposed changes that you support, raising the cap, that sort of thing, is gonna change that at all?
I think it's that $1 million cap. People that are looking to do real estate deals typically need more than $1 million. Also, regulation crowdfunding is all or nothing financing. So if you set your threshold at $1 million and you come in at $950,000, you're not getting any of that money. So there's a lot of risk for those type of real estate companies that are looking to raise money via regulation crowdfunding that I don't think it necessarily makes sense within this framework. I think there will be more real estate companies or developers that come into the market and try and use regulation crowdfunding once they increase the cap. But I still think there's other avenues under the Jobs Act that probably make real estate, a better area for them to raise capital than through Reg CF.
Right, right. Okay. You mentioned the sort of all or nothing thing. So the companies they set a target, and if they don't achieve the target, then it's nothing, right? I spent some time a couple years back, kind of digging into the Edgar filings and looking at some of these, the Form Cs that companies filed to raise. And what I noticed, an interesting kind of pattern over time, is companies starting to set that goal very, very low, and in some cases, very low. And I think, I don't know, I'd be curious your opinion on it. Then you sort of look at the platform itself, and you see, we've achieved 5 times our goal, right? It's almost
Right,
like
right,
it's sort of under promise and over deliver in
right.
action there. And I was curious. In some ways, it sort of seemed a little bit like, not kind of clever, I guess I'll put it, way to sort of
That was
imply
kind of you.
level of success. But it did kind of seem a little bit, maybe a little bit not what was intended.
Yeah, I've been personally frustrated with that as well. I think if you're putting an offering together and you are trying to raise money from the crowd, you need to be sincere in how much you need and how you're going to spend it. So this is where you can get a little more intel. On Form C, they set low thresholds as to what their minimum capital they need is. But if you go to the campaign pages, you'll see that they have a use of proceeds. So you can see that they've got a worst case scenario, which is usually that very minimum amount, a better and a best case scenario. So they're aiming for higher amounts, but what they're saying is we really would like to keep what we can get. So they're setting this low bar. I would, personally like to see people be more honest in how much they need and put that as their use of proceeds and put that as their minimum funding target.
Yeah, yeah, absolutely, absolutely. So I see you've got a lot of books on your shelf behind you. Something I like to ask folks I talk to is, do you have a favorite book on investing that you've read, and what that is, and why it's your favorite? And I'm sorry you don't get to say Crowdfund Investing for Dummies.
It's right there anyway. So this is interesting. My background is an entrepreneur. So before I got into this, I had started a company called Flavor RX with my brother-in-law. We flavored medicines for children so they're more compliant. It went from one pharmacy to 40,000 across the United States. We did multiple rounds of financing. And I read a ton of books about how you make small ideas into big ones. And the book that I read that made the most impact on me as an entrepreneur, and since starting crowdfunding, and we started a venture fund to invest in the crowdfunding ecosystem, so the technology companies itself, was Good to Great. Because that taught me as an entrepreneur what it takes to take a good idea and make it a great one, and how you need to have a team that is focused on that. So whenever I've made investment decisions, I've been very focused on the executive team. What's their experience? What have they done in the past that has shown they can actually accomplish what they say they're going to do today? And look for examples of how they've broken down what it is that they need to do and shown me these were our goals. Here's our milestones. This is what we achieved over that time. And this is what we need to fix going forward. I'm fine with problems. I realize things change. COVID comes into existence. Nobody expected it. But it's how can you pivot? How can you stay on top of it? What are you going to pull from that's going to allow you to excel? I assume when anyone comes to me that they've got a great idea, they've got the technology built, and they got a customer already using the product or service. Those are like the minimum things that I'm looking for. But Good to Great taught me how to look at a business and how to look at the executive team and figure out whether or not it's the right company that I want to invest in.
All right. Well, thank you very much. Well, Sherwood, I appreciate you taking the time today. You have obviously been a really instrumental part in building out this ecosystem. A lot of investors and entrepreneurs, certainly owe a lot to what you've helped to do here. And I appreciate you taking the time to talk with me today.
Yeah, thank you for having me. It was great.
All right. Thanks, Sherwood.